How factor investing can help you build a successful investment portfolio and boost your returns. In today's program, we delve into factor investing and discuss why this particular investment strategy can help individuals and institutional investors boost portfolio returns. Also explored are the best ways to use factor investing to reach portfolio resilience, invest internationally, and allocate resources sustainably. Stay tuned. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. I'm doing marvelous. And if you are doing as marvelous as I am, go grab a cup of coffee or tea or vodka and let's roll. Today we have a very interesting conversation here because factor investing has gained a lot of publicity and popularity in the last 2 decades, specifically among portfolio managers and institutional investors. But today's conversation is geared not only towards a sophisticated investment, audience, but also to the regular Joe, the average Joe here. All right, so whether you are an individual or you are an institutional investor, you'll find this presentation very interesting. Now, when we talk about factor investing, what do we mean? What are factors? Now, factors are the foundation of portfolios, right? So factors, if you will, are the broad, comprehensive, persistent forces that have driven returns for a wide area of assets, including stocks, bonds, ETFs, and so on and so forth. Now, factor investing leverages advancement in everything from data and technology into artificial intelligence to deliberately seek these historical return drivers in portfolio. Now, understanding how factors work can help you capture the potential for excess return and reduced risk, especially in the long run, because if you're looking at 10 years, 30 years, 20 years, there is an ability to include factors into your investment strategy to lower the risk while increasing the ROI. All right. And the thing here is that, again, the factors investing applies then not only to a regular average Joe, to passive investors, but also active fund managers and institutional investors. Now, let's talk about the types of factors, right? There are 2 main types of factors. When investment specialists talk about factors, they talk about 2 main types. You have macroeconomic factors, and those capture broad risk across asset classes, and style factors, and those help to explain returns and risk within asset classes. Now, let's quickly just delve into each category here, each of these 2 categories here. Macroeconomic factors include things like economic growth. So when you invest, when you are a factor investor and you want to focus on macroeconomic factors, you focus on economic growth, right? In other words, the stock or bonds you're buying, what is its exposure to the business cycle, right? Another factor is real rates. So that's the risk of interest rate movements. And this is very important for fixed income assets, including bonds. Another macroeconomic factor is inflation, right? So changes in prices can have an exposure, can have an effect, if you will, upon bonds and stocks, depending upon the economic cycle and the company, the company whose asset you've bought. Credit is also an important macroeconomic factor. Right here, I'm talking about the default risk from lending to companies, right? This is very important. Another macroeconomic factor is emerging markets. So when it comes to emerging markets, the factors you want to pay attention to are political and sovereign risk, right? Everything from expropriation to political instability, that kind of stuff. We actually did a show recently about something called ISDS. So that's the super court that arbitrates I would say, disputes between investors and nation states. You might want to check that. So when it comes to emerging markets, you have that political and sovereign risk. And the last macroeconomic factor you want to pay attention to is liquidity, right? So if you were to hold illiquid assets, you have to gauge the risks that goes with illiquid asset versus liquid asset and make a determination as to which one works for your portfolio, depending on your risk profile, right? Whether you're risk averse or a risk taker. So that's basically that's it for the macroeconomic factors. Now let's move on now to the style factors. For style factors, we also have 6 factors here. So value. So if you are a factor investor, you can focus on value. In other words, you're looking for stocks that are discounted relative to their fundamental values, right? So if you have someone like, if you have an investor such as Warren Buffett, he's a pure value investor. So he's a factor investor, but focusing on value, right? Another style factor is momentum. So momentum is very important because momentum shows you the stocks that have an upward price trend. You want to focus on minimum volatility, which is another style factor. So minimum volatility sort of dictates that you focus on stable, lower risk stocks. The quality of the companies you're buying. So you want financially healthy companies. The size, it's another thing you want to focus on. So smaller, high growth companies or larger companies. And the carry. So the carry really talks about the income relative, the income incentive to hold riskier securities, right? So those are the types of factors: macroeconomic factors and style factors. I'll be right back right after this. Welcome back, folks, to another edition of Sweetie Kiwi. I'm just very happy to have this conversation with you today about factor investing. So in the first section, we talked about what factors are and gave you different types of factors, right? So macroeconomic factors and style factors. Now, let's have a quick conversation around why do you need to invest in factors? Now, factor investing, believe it or not, is the way of the future, right? Because if you think about the global economy and global financial markets, where you have an abundance of players, both individual, both human and machine, right? You need to have a strategy, and factor investing is a strategy that has proven itself over and over the last 100 years, going all the way to 1919 or 1924. All right. So the thing here is that data and technology have popularized, if you will, factor investing, because they have allowed all investors to have access to this historically persistent drivers of return. All right. And the thing here is that you're able now with, even if you're a retail investor, you're able to use apps, to use software to be able to identify, for example, which stocks or bonds or ETF or mutual fund, you name it, fits the specific factor you want to focus on, right? If you want to focus on a company that is inflation driven, that has high exposure to changes in price, you have tools today to identify that. If you want to focus on a company that is a quality company when it comes to its finances, you have tools that can analyze, the company, look at the financial ratios, and tell you, boom, this company is a quality company. So now, in the era of technology, in the era of internet, you can invest in factors and actually boost your portfolio's ROI significantly. Let's move on now to another aspect of factor investing. Now, factors can help meet your portfolio objectives. If your goal as a portfolio manager or just as a retail investor, if your goal is to outperform the market, there are factors that you can use to outperform the market, to produce above market returns. Of course, here things don't have to be unidimensional, right? You can have a multi-factor strategy. You can basically combine 2 or more factors among the 12 that I have listed earlier. Again, just kind of quickly recap here. The factors are sort of split into 2 categories. You have macroeconomic, that's economic growth, real rates, inflation, credit, emerging markets, liquidity, and style factors. And style factors include value, momentum, minimum volatility, quality, size, and carry. Okay, so you can use factors to outperform the market. You can use factors to manage risk, because factors, when used properly, allow you to minimize volatility in your portfolio. Factors can also help you enhance diversification across the portfolio, so you're able to allocate resources across macro factors to seek a greater portfolio diversification. And we all know how important it is to diversify, not to put all your eggs in the same basket, right? So this is basically it when it comes to factors helping individual investors meet portfolio objectives. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still having our conversation today about factor investing and how this particular type of investing can help you build a successful investment portfolio and boost your returns over the short or long run, right? Now, I want to give you 3 factor-driven investment strategies that you can use to boost your portfolio returns. Now, the first one is called portfolio resilience. Now, what is resilience? Now, portfolio resilience, it's simply the ability of a portfolio to withstand various adverse conditions. And again, this can be on a short-term basis or in the long run, right? The idea here is to have a defense, to play defense, right? So you want your portfolio to be resilient, to be able to withstand, for instance, what happened in 2008 with the Great Depression. You're able, if you had a resilient portfolio, the impact of such a dramatic event will be very minimal on your portfolio in terms of ROI, right? So you can use, there are a lot of products out there, there are a lot of assets out there, but bonds play an important role in portfolio by serving as a buffer against sell-offs of risk assets, right? Risk assets being including stocks. So bonds and fixed income products in general are crucial diversifiers, both in the current conditions but also in the long run, right? And another thing you can also use, in addition to another security group or another security category you can use in addition to bonds, is low volatility equity. So the blue chip stocks usually can help create a low volatility portfolio that will help you withstand various nefarious conditions in the long run. So that's for the portfolio resilience. First strategy. The second factor-driven investment strategy is sustainable investing. Now, sustainable investing is exactly what it says. It's a strategy that puts a bigger impact upon investing in progress. So what you're trying to do here is that you're trying to allocate resources into companies that solve some of the world's biggest challenges, right? So if you identify a company that is solving a big problem that, you know, for instance, in the environment field, and you see that they're doing something big and they are poised to grow, you can buy their stocks, right? So the sustainable investment is about pioneering better ways of doing business, right? And creating the momentum to encourage more and more people to opt in the future we're working to create. So this is very important. And what you want to do here is that You want to be able to combine here. You can combine several factors. We talked earlier about, for instance, when it comes to style factors, you can use value stocks, for instance. You can combine them with emerging market, which is macroeconomics. So you're able to find a company that is fundamentally sound, but very discounted by that company, even if the company is not operating in the United States. All right, so this is it for sustainable investment. The third factor-driven investment strategy is international investing. This sort of harks back to what I said earlier about investing in emerging markets. International investment is pretty cool when it comes to diversification. It's pretty cool when it comes to ROI boosting, right? It allows you to select global investment instruments as part of an investment portfolio, right? So you are not only expanding diversification here, you're also distributing investment risk between markets and global companies, right? Remember, you are able to invest in markets that are not correlated to the United States market. So you have diversification right there, right? So you can decrease the potential negative impacts of local market volatility, in this case, US market volatility. You access growth, right? So if there is growth, if there is economic boom in foreign markets while the US economy is stagnating, you're able to actually grow. Remember, like sometimes when it's raining in China, it might be sunny in Brazil. Or when it's snowing, if you will, in Canada, it might be it might be sunny in Angola or in Singapore. So the ability to diversify your portfolio through international investing is pretty important, especially in the long run. So those are the top 3 factor-driven investment strategies that can help you build a successful investment portfolio and boost your return. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're about to wrap up today's conversation about factor investing, and very quickly want to give you a recap of today's conversation. We spoke about what factors are in the context of factor investing, the types of factor, right? So the macroeconomic factors and the style factors. I explained to you why you should definitely invest in factors. Now, of course, folks, this program is not about giving financial advice. We're not specialists. We're not licensed to do this. Every person's situation is different. I would suggest that you enlist the help of an advisor, of an expert, if you need such help. Here, we are giving you this is a general information show. We're providing basic information based on fact, of course, but before you make a determination, you want to consider your own personal situation. All right, so why you should invest in factors. Number 4, factors can help you meet portfolio objectives. I explained to you why. And the last section was about factor-driven investment strategies, where I gave you 3 factor-driven investment strategies, namely portfolio resilience, sustainable investing, and international investing. Now, here is today's pro tip. The thing here is that when it comes to factors investing, you want to not only look at the global economy, but also the local economy. And when it comes to local economy, things like business spending, interest rate, manufacturing, among others, are very important. You also want to pay attention to the housing market. You want to pay attention to housing trends, right? So it's not just something that you have to look at overall, globally. You want to look local also. In today's world, of course, China and the United States occupy basically the center stage when it comes to the global economy. So if there is any turbulence in the relationship between those two behemoths, the rest of the world will feel it, right? There will be some kind of a ripple effect. So you want to pay attention to that as you construct your portfolio. Another thing you want to pay attention to is the uncertainty around China's economic outlook, right? And the potential policy response, because there are a lot of stuff happening in China not only socially, economically, politically, and given the fact that it's the second largest economy right now, anything that goes on in that country will affect your portfolio. So you might want to think about that also. You also might want to think about Europe and other emerging markets. Europe is not an emerging market, but Europe is more of a mature market. But you want to think about Europe as one category of markets, but also the emerging markets such as Russia, Brazil, South Africa. And the last thing I want you to think about when it comes to building a factor-driven investment portfolio is to think about the business cycles, right? So business cycles are very important. We not long ago in 2008, we were in a recession, and then it took some time. So sometimes value investors such as Warren Buffett will buy when everybody is selling. In other words, they will never buy when everybody else is buying. They buy based on value. So sometimes market corrections are opportunities to enter the market. All right. Thank you for your attention, and I will see you next time. Remember to stay marvelous.